Welcome back to the Business Book Club. We're really excited you're joining us again. Today, we're jumping into a book that honestly just keeps resonating. It's Morgan Housel's The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness. Our goal today is, to pull out the most valuable insights, specifically for you, the entrepreneur, give you maybe a fresh angle on building real, lasting financial success.
It really is a fantastic read, and Housel's main point, it sort of cuts through all the usual financial jargon, doesn't it? He basically argues that financial success isn't really about how brilliant you are or, how complicated your spreadsheets are. It's much, much more about your behavior, how you act, your psychological relationship with money.
Right. Less hard science, more soft skill.
Exactly. It's driven by emotions, by our actions, not just formulas.
And he kicks things off with this incredible story that just nails that point. Two guys. First, there's Ronald Reed, a janitor, gas station attendant, lives super quietly in Vermont, saved consistently, patiently invested in good, solid blue-chip stocks for decades, passes away at 92, and surprise, he's left over $8 million, mostly to the local hospital and library.
Wow. Okay.
Yeah. Then you got Richard Fuscone, Harvard education, Merrill Lynch executive, MBA, everything. Seen as a finance whiz.
Right, the expert profile.
Totally. But he got caught up wanting more and more, borrowed a ton of money, built this huge, 18,000 square foot house. Then 2008 hits, and all that debt, the illiquid assets, boom, bankruptcy.
It's such a stark contrast that the janitor becomes this quiet millionaire philanthropist, the finance exec goes bust.
Exactly. And the takeaway isn't about their IQ or market access. It was all behavior. Reed's patience, his frugality, versus Fuscone's, greed and overreach.
And that's kind of unique to finance, isn't it? Like you said, you wouldn't expect a janitor to be a better surgeon. But with money, behavior can genuinely beat brains. It's a powerful lesson right off the bat.
So if behavior is key, where does it come from? That leads into the first big idea from Housel. No one's crazy.
Yeah, this is fundamental. It means that the financial decisions we make, they seem logical to us based on our own unique lives. Your upbringing, your parents' habits, the economy when you came of age, your income. It all shapes how you see money.
That is so critical because our own little slice of history, it feels like the whole world, doesn't it? That anchors our view. If you started your business, say, during a tough recession.
Your risk appetite is going to be totally different from someone who launched during a boom time.
Exactly. And Housel mentions a study, I think, from 2006. It confirmed investors' risk tolerance ties back to personal history, not smarts. Understanding this helped you look back at your own choices, maybe with less judgment, right? More empathy. And then build a financial path that actually fits you.
Precisely. It's about aligning with your psychology, not just some abstract, rational ideal.
Okay, so moving on, compounding. Our brains are notoriously bad at really getting compounding.
Oh, absolutely. We think linearly, A to B to C. But compounding is exponential, it curves upwards, and it's hard to grasp intuitively.
Which brings us to Warren Buffett. Everyone knows he's a great investor, but Housel points out his real superpower isn't just skill, it's time.
The numbers are just staggering. Something like $81.5 billion of his $84.5 billion net worth came after he turned 65.
That's mind-blowing.
It really is. If he'd started investing at 30, got the same amazing returns, but stopped at 60, his wealth would be 99.9% less.
Wow. So the lesson for you, the listener, the entrepreneur, it's about sticking with it, consistency over the long haul.
Exactly. Those steady, pretty good efforts maintained for a very, very long time, that often beats chasing those quick, flashy wins. Longevity in your business, your investments, your habits, that's where compounding really works its magic.
Okay, so from compounding, Housel talks about this idea of tails. You win.
Yeah, this is another powerful one. It basically says that in many areas, business, investing, even creative fields, most of the results come from a tiny number of events. The outliers, the long tails.
Right, like in venture capital.
Perfect example. Most VC investments, maybe 65%, lose money or just break even. A small fraction, maybe 0.5%, return 50x or more. And those are the ones that make the entire fund profitable.
Or even looking at the stock market itself.
Yep. Housel points out something like 40% of all public stocks have been catastrophic failures over time, but just 7% of companies account for almost all the market's overall gains.
So for an entrepreneur, this should actually be kind of freeing. It's okay if not every single idea is a home run.
Absolutely. It's normal for lots of things. You try products, marketing campaigns, new ventures to fizzle out or just be okay. The key is to keep trying things, experimenting, because you're looking for those few big wins, those tails, that will likely drive the vast majority of your success.
Don't get bogged down by the misses. Focus on the potential for those big hits.
Exactly. See the failures as data points on the way to finding what really works.
Okay, let's shift gears slightly. Housel makes this really interesting distinction between being rich and being wealthy.
This is crucial. Being rich is often about current income, visible spending. The fancy car, the big house, you can see it.
But wealthy?
Wealth is hidden. It's the income you didn't spend. It's the assets you own that haven't been turned into stuff yet. It's savings, investments working quietly.
And because it's hidden, it's harder to learn from, right? We see the rich person's car, not the wealthy person's brokerage account balance.
Precisely. Which leads directly into what Housel argues is the greatest value money provides.
Freedom.
Yes, the ability to control your own time, to wake up and say, I get to choose what I do today.
It's not just about buying more stuff.
Not at all. It's about autonomy. He cites research by psychologist Angus Campbell showing that having a strong sense of controlling your life is a much more dependable driver of happiness than your income level.
So for you, listening, the goal isn't just piling up cash. It's using that cash to buy yourself options. Flexibility.
Right. The ability to take a sick day without worrying. Or wait for the right business opportunity instead of jumping at the first thing. Or maybe just not living in fear of your boss because you have that cushion.
That control over your time.
Yeah.
That's the real dividend.
Absolutely.
Now, related to making decisions, Housel has this great chapter arguing we should aim to be reasonable rather than purely rational.
Yeah, I love this one. It's acknowledging we're human. We're not robots or spreadsheets. We have emotions, biases, fears.
So trying to be perfectly rational all the time is realistic.
Pretty much, and often counterproductive. Because
Yeah.
a strategy that's technically optimal but makes you so stressed you can't sleep or stick with it, that's useless in the long run.
He tells that story about the Nobel Prize winner, Harry Markowitz.
Right. The guy who literally invented modern portfolio theory, the mathematical definition of rational investing. Yet, when it came to his own money...
He just split it 50-50 between stocks and bonds.
Yeah. Why? He said it was to minimize my future regret. That's a reasonable emotional goal, not a purely rational calculation.
So the takeaway for entrepreneurs is huge here. Don't beat yourself up for not having the perfect financial plan or business strategy.
Exactly. Focus on finding a pretty reasonable approach. Something good enough that you understand that feels right to you and that you can actually stick with through thick and thin. That's far more effective over time.
Okay, and sticking with things leads us to maybe the most foundational piece, saving money.
Ah, yes. Back to basics, but so crucial. Housel really hammers this home. Building wealth often has less to do with how much you earn or even your amazing investment returns.
And way more to do with your savings rate, how much you consistently put aside.
Yep. And the psychology here is interesting. He offers this little formula. Savings equals ego minus income.
So the less you need to spend to impress others.
The easier it is to save. It connects saving to humility, to caring less about keeping up appearances.
That's powerful. And he also makes the point that you don't always need a specific goal for your savings, right?
Correct. Saving for a down payment, retirement is great. But just saving for the sake of saving, that's vital too. It's saving for the unexpected. The surprises life inevitably throws at you. It builds resilience.
It buys you that flexibility again, that control.
Exactly. That cushion of savings, without a specific label on it, gives you options, freedom, the ability to weather storms or seize opportunities. It's a huge competitive advantage, especially in the volatile world of entrepreneurship.
Okay, so we've covered a lot of ground. Let's try and distill this down. For you, the entrepreneur listening right now, what are the big actionable takeaways from the psychology of money?
Yeah, let's boil it down.
First, I'd say embrace survival and longevity. Think like Buffett in terms of time. Focus on being financially resilient personally and in your business. Aim for those pretty good efforts you can sustain for the long haul. Compounding needs time.
Good one. Second, learn from tails, you win. Remember that it's normal for many ventures or ideas to not pan out. Don't get discouraged. Focus on trying things because a few big successes, the tails will likely drive most of your growth. Keep experimenting.
Third, value freedom and flexibility above all. Use money primarily as a tool to gain control over your time and your choices. A strong savings rate isn't just about getting rich, it's about building agility and options. That control is priceless.
Hmm. Fourth, define enough. This is critical. Avoid that trap of always needing more, which can lead to ruinous risk-taking. Know what's truly valuable: reputation, freedom, relationships, and don't gamble them away chasing an ever-receding goalpost.
Fifth, be reasonable, not just rational. Your decisions are human. Choose financial and business strategies that you can emotionally commit to, that let you sleep at night, even if they aren't mathematically perfect. Sticking with a good plan beats abandoning a perfect one.
Sixth, plan for surprises with room for error. The future is unpredictable. Build buffers, financial cushions, operational flexibility into everything. Avoid single points of failure. You need that margin of safety to survive the unexpected.
And maybe finally, identify your game. Don't get swayed by what others are doing, especially those playing a different game with different timelines or goals. Stay focused on your own long-term vision and risk tolerance.
Those are excellent takeaways. They really capture the essence of Housel's wisdom, focusing on behavior, psychology, and long-term thinking. It's less about financial wizardry and more about mastering ourselves.
Absolutely, it's a mindset shift.
It really is. Well, that's all the time we have for today's deep dive. If you found this valuable and want more insights into essential business and finance ideas, definitely subscribe to the Business Book Club.
Thanks so much for tuning in. Now, that's a wrap for this episode of the Business Book Club. If you enjoyed the ride, make sure to subscribe so you'll never miss our next deep dive. Got a favorite business book you'd love us to explore? Let us know. We're always up for a good read. And hey, don't keep all these insights to yourself. Share this episode with a fellow book lover or your work buddy who's always looking to level up. Until next time, keep learning, keep growing, and we'll see you in the next episode.